All right, Richard, do you want to wait a little bit longer for people to join, or do you want to get started?
I think we just get started, and it's folks will show up if and when they show up.
Sounds good.
So, go ahead.
Oh, I was just going to say a big thank you to Bo, who hosted the meeting 2 weeks ago while I was gone. I had a great vacation. It was my 15th wedding anniversary, so my wife and I escaped away to a little bit of heat down in southern Texas and had a really good time. Thank you to Bo for stepping in, and also to Viking Capital. I didn't really get to hear their presentation beforehand, but hopefully it went well. I'm interested in people's feedback on how it went. So with that, we have a couple of speakers that are coming up. We have one who is going to be talking to us about Airbnb and the Airbnb business, and another who is into real estate tax advantages. And so coming up soon, we'll have how to save on your taxes using real estate. And those are our two upcoming topics. And for now, this is Richard McGrew, and he's going to present his second part on note financing. So Richard, I'll hand it off to you.
Great. Hey guys. So how many folks are on the call, or maybe a wrong way to ask it? Is there anybody on the call who saw last meeting about 3 weeks ago where we presented the first half of this deck?
Yes, it was very good too. You could tell that we all wanted to hear more.
Yeah. Okay. Good. Is there anybody on the call who did not see that first presentation?
Right, I haven't seen that.
I didn't.
Okay, that's two. All right. So, Daniel, I'm open either way. Maybe I'll ask the folks that are on the call. Would those of you that saw it last time mind going through it again? That way you kind of get a second pass at it.
I would love to see it again. Yeah.
Okay. Anybody who
because it was pretty dense,
Yes.
There was
right.
a lot there, and
that's
you were
right.
going fast. So
I was.
Yeah,
I think
definitely.
I was trying to get through it quickly.
Definitely.
Okay.
Would welcome seeing it again.
Okay. Anybody object to that? Come on, we're Intel, constructive confrontation. Feel free to jump in and disagree. Okay, I'm going to go ahead and jump in. I'll just start from the beginning again. I will try to slow down a little bit. You guys can always speed me up if I'm going too slowly. I've been a note investor now for just, I guess, about 3.5 years. I got into note investing because I didn't want to deal with tenants, toilets, and termites in rentals, but I wanted something where I could generate relatively passive income based on capital outlay up front. So we'll talk about what note investing is and what it looks like, and then maybe at the end you can ask me the question of whether it turned into a passive income or if it was a lot of work. So we'll just jump right in. I skipped over the legal disclaimer. Obviously, this is Intel. I'm not here to sell you guys anything. I'm just here to share what I do and see if you guys want to participate. If so, I can point you in the right directions around the country. So back in 2008, there was a market crash. We all know about that. There was a lot of money lost in the stock market, and the reality is a lot of investors pulled their money out. They needed someplace to put that capital, and note investing is one of those places that benefited from that removal of capital from the marketplace. So we're all familiar with a chart like this. This chart's about a year out of date. It's continued to go up and to the right, and I think we all believe it's going to keep going up forever. That's why we attend real estate meetings, right? Just kidding. I hope it doesn't go down, but I feel in my bones that it will someday, and I'm hoping to have myself diversified outside of the stock market and bond market so that if the market does crash, I've got my capital also in other places that may or may not go down during those downturns. I think a lot of people believe that real estate is a different market than the stock market. I grew up at Intel. I've been here 23 years, putting every extra penny I have into my 401k, and so I've got a nice big pile of money there, but it sure is, I feel like, pretty dangerous to leave it all there. So I've been moving my money into other avenues, even though in the stock market, the money that I have in my 401k, it's all quote unquote diversified, which means it's just in other forms of mutual funds and stocks and bonds and other miscellaneous stuff that the Wall Street folks would have us believe is diversification. But I think if you have half a brain, you can tell that's just marketing mumbo gumbo, and it's not diversification at all. I would argue that there are lots of alternative investments that are very much separated from the stock market that can have ancillary impacts, obviously. But the note investing market is an interesting space, and I'll walk you through kind of what that market looks like. I believe investing in real estate is risky, so I would never tell anybody it's not risky, but I think the risk profile is very different than stock market, and I think that when the stock market falls, real estate may or may not follow with it. So enough said. I believe the stock market looks a lot like this, and if you're old enough, you've lived through a few of these downturns. I've been through a couple myself. We're going to talk about note investing. So what's a note? A note is a $100 bill, right? So if you have paper that you give somebody for value, that's a note. You can write a check, and you can get a car loan. You can get a mortgage loan. These are all different examples of notes. We're going to talk today about this last one, mortgage notes. So you all know when you buy a house, you sign a mortgage and a note. This example here is a note for $100,000 with an interest rate of 10% for 360 months. That payment would be $878, and you would sign that, and that would be a binding agreement for you to pay back that amount of money to somebody with a security agreement against usually a piece of collateral, which is the asset, the home that you're buying. So let's just walk through a typical transaction. So I've got a seller, I've got a purchase price on a house of $110,000, and I've got a buyer. I've got a mortgage lender involved. So let's just talk about what's going to happen here. So the buyer is going to give a $10,000 down payment to the seller. The buyer is going to sign a mortgage note over to the bank for $100,000, and they're going to give that $100,000 to the seller. Make sense so far?
Mm-hmm.
Pretty simple. Daniel, you don't get to answer. You've already seen this. Okay, so pretty simple so far. Now that seller is going to transfer the deed to the property over to the buyer. And the buyer is going to make their payments to the bank. All right, so that's a typical home ownership transaction. Note there are two documents that secure this transaction. One of them is the mortgage note. That's the documentation of the terms that are the money that's due. And the other one is the mortgage deed or ownership deed or trust deed. There's a lot of different names for it, contract for deed. And that is a security agreement that says the mortgage note is secured by the real estate that's being purchased. Okay, so in comes Richard McGrew here, the investor, and I got a little pile of money that I want to spend. I'm gonna buy that note from the bank, and they're going to transfer that note over to me, and now the buyer is going to make their payments to me. Anybody have any questions about that? Makes sense. Okay, good. All right, let's walk through a case study. Here is my first note that I bought in New Vienna, Ohio. It's a 4-bedroom, 2-bath, 1,900 square feet home on 2.5 acres. Absolutely beautiful home. It's the nicest home in this area, and its current market value is $120,000. I would live in this house any day. It is absolutely gorgeous, and I cannot believe, I've been in California my whole life, I cannot believe a home like this sells for $120,000. Okay. So here's the situation. The house was worth $120,000. The owner put down $16,400, so they've got a small amount of equity in the home, and they take out a mortgage note for the remaining $103,600 at 8% for 360 months, which gives them a payment of $759.46. Who wouldn't love that payment on a 4-bedroom house, huh? All right, so that loan, that mortgage note is a first lien on the property, secured by the property. This makes sense so far? Okay, pretty typical. I think most every. Oops, go ahead.
No, I mean you did a really good job of explaining this, Gus. Because if you read it in text, sometimes it can be very confusing. But you did a very good job visually. I think it does it justice.
Cool, thank you. Okay, so this is pretty typical transaction. Most of us here probably have bought homes, and this is what we typically do. Put some amount of money down, there's a mortgage note left over, and somebody owns that note. Usually it's the bank that you used to get the money from. 162 months later, which is what, about 13 years? No, yeah, about 13 years, something like that. They now have made some payments, 162 payments, and they have an equity in the property of $36,593. And their mortgage note now, the balance on the note is only $83,407, down from the original $103,000. All right, there are 198 payments remaining. This is when I came in and purchased this note for $69,175. Now somebody should ask, hey Richard, why did the bank sell you? First off, why did they sell you the note? And then second, why did they sell it for only $69,175 when there's $83,407 remaining? Anybody want to know the answers to those two questions?
Yes.
Yep.
Yeah, all right. I figured somebody might want to know. All right. I always get asked those questions. So why do banks sell mortgage notes? There's a lot of variable reasons, but some of the typical examples, probably the most prominent one, the first 5 years of a mortgage loan, especially a 30-year loan, you're paying almost 100% interest, which is pretty much the cream of the crop. It's just all profit for the bank. As you start to pay off that mortgage, more and more of your payment goes to principal, and the bank is making a lesser and lesser overall return. So what they'll do is they'll sell those notes off to some unsuspecting sap like me, who will get less profit than they would have gotten, but for me it's actually quite good, and they will then move on to the next property. Now, why did they sell it at a discount? They sold it for $69,175 instead of $83,407. Well, in this case, the papers, we call the loan a paper, basically, and the paper is not the prettiest paper in the world. This borrower didn't make 162 payments every single month. The home is in a nice area, but and the collateral's nice, but the job market's not super strong. It's not perfect like it would be, say, here in Folsom, California. So there are mitigating factors that cause banks to sell mortgages for less than the full value, but also they can't sell at full value. Nobody would buy at par or at exactly the value. A typical discount from a bank depends, of course, on the quality of the paper and the borrower and the asset and everything, but a typical discount on a performing loan is around 20%. So you'll typically see a performing loan sold for about 80 to 85% of its unpaid balance. Sometimes a little higher, and then sometimes a little lower if the paper's pretty bad. So in this case, they sold it for, I think it was 83%, if I remember right, which is what I paid for this loan.
I have a question. So what do you mean by paper is bad?
Oh, sure. So for you and I, right, we live in California, we have great jobs, we have great homes, we live in the best part of the world, in my opinion. The paper that we sign to buy homes is perfect. The banks spend a lot of money to make sure that every single detail is covered with regards to disclosures and background checks, and of course your credit is near perfect and all these things, right? So that paper is super high quality, and to buy our mortgage note, if I could even find them on the marketplace, I'd probably pay 95% for our notes. But for these notes, maybe there's a secondary a lender in the marketplace that did paper on it and it wasn't perfect. You rarely see big banks in these small areas out in the Midwest. They're generally local banks, and their paper's okay, it's just not perfect.
Okay.
So generally, quality paper means all the background checks were done, all the proper disclosures were done. There's no issues with how it's written. That's those the kinds of things you're looking for with the quality of paper.
Basically, less risk kind of.
That's right. Gotcha. That's right.
Thanks.
Yeah, and you can have a terrible borrower, but if the paper's perfect, at least there's no likely holes in getting paid back when things go wrong, right? So. All right, so I'm going to move on. So basically, this first position loan was purchased. I think it was in 2017. I bought this loan, and for $69,175, I bought $83,407 in payments. Those payments are $759 a month, and so those payments start to come into me. My little mailbox over here on the left loves to get those paychecks every month. It's pretty nice. Now, if that continues for the 198 times, that would be a total of $150,373 that I would receive over that time frame, which is an effective annual interest of 11.2%. So that's not a super sexy return, but it's a lot better than anything I'm getting on traditional investments, except for the stock market right now, which of course is going through the roof. We already talked about that. Any questions on how I got to 198 payments, why that equals 150,000, and why that's an 11% return? All right, and I can bring up Excel and we can walk through all the math if you guys are interested in. You're probably, most of you are engineers in the room, so you understand the math quite easily. All right, so now that I own this loan, how can I get out of it? Let's say I don't necessarily want to keep it the entire time and make that 11.25% return. This 198 payments is a long time. Well, one option, so option one is just keeping it for maturity. Another option, people sell their homes and they refinance their homes. So it is very possible that this borrower could sell that home or refinance it. The average time in the U.S. today, I think, is 8.5 years between them buying a home and selling it. So it's not unrealistic that in that 198 months that this borrower could decide to get out of my loan. In that case, they have to pay me off before they can move on. And so if you think about it, I paid $69,000 for a loan worth $83,000. If the day after I bought that loan, they paid me off, then I would have received my full $83,000 back, which is a $14,000 profit. I would have made that profit in one day off of a $69,000 investment. That's absolutely viable. It can happen. It hasn't happened to me yet, but it can. And that return, of course, is much, much bigger than 11%. The 11.25% return is only if it goes all the way through maturity, paying every month. Was there a question?
Yeah, Richard, do you deal with assumable loans at all, or are all your loans due on sale?
I haven't seen any paper come across my desk that were assumable. The downside to an assumable loan would be that if the new borrower comes in and I have no control over whether they come in or not, if they come in and their credit is terrible, then my risk is increasing. Right. But I haven't seen any assumable paper. I don't think many people write that kind of paper. It's possible, though, that it could exist.
I have another question. Why is the return higher if you accept an early payoff? I still don't understand that part.
Sure, no problem. So let's go back and look at the deal. So I paid $69,000 for $83,000 in unpaid balance, right?
Right.
So if on day one I paid $69,000 and they pay off, they refinance, I get a check. I wrote a check for $69,000. I get a check back for $83,000.
Okay, so only because of the discount.
That's right. And if that happens in one day, my yield is several 100%.
Got it.
Right? Annualized yield.
What's the tax category for that $759 coming in every month?
That's a great question. This is taxable income. So the way that I purchased it, and if you guys want to get into actually thinking about doing this business, I would recommend we set up something with your self-directed IRA and not use direct cash. This is not the best investment class for cash, since there are no tax benefits or tax breaks for mortgage note investing. Versus if you buy a piece of real estate, the government is very heavily incentivizing us to buy real estate, and they give us nice, pretty tax breaks and all that. Okay, so which of course that's a great question, and that drops your return. Obviously, my 11.25% return is assuming I'm using tax-free money and that I'm not using cash from my bank account.
How difficult has it been for you to set up the self-directed IRAs for this?
It's really pretty trivial. If you have, the hardest part is on the transaction. They're kind of butt heads about all the little details being done before they let you close a deal. It just takes an extra week or two, versus just buying with cash. But they generally close deals. And as far as setting up the self-directed IRA, I think we talked about that in a prior meeting. We can bring somebody in to talk about that. There's what they call custodians. These are third parties that manage other people's money. They basically are they're used to dealing with the IRS, and their job is to make sure that we don't do anything that's illegal with our IRA money. Basically, you fill out a form that transfers your 401k from your current 401k holder or IRA holder over to one of these custodians, and the custodian then holds the money, and then you tell the custodian what you want to buy, they then issue the check, and the ownership of the asset that you purchase goes back to the IRA, not to you. So you don't actually own, you're not the beneficiary of the asset, but you are a beneficiary of the IRA. And so as the IRA grows, or as the asset grows, the IRA will grow, and as the IRA grows, of course, your long-term wealth increases. So that's the high-level concept. We can get somebody who's professional and knows how to speak to IRAs, self-directed IRAs, to come in, but it is quite easy. My wife and I have got 3 of them that we're currently managing to purchase real estate with. It's not complex. Although I probably made it sound complex. It's not complex.
There's a question on the chat.
Yeah, go.
The question on the chat says, the original value 13 and a half years ago was 120K, and it is currently appraised at the same 120K value, question mark.
Yeah, it's a great question. So this asset is, most of the assets that I purchase on this market are available in the Midwest. The Midwest does move around a little bit, but nothing like what we're used to seeing on the coast, on East Coast and West Coast. And we're on the West Coast specifically, which is where I live. We're programmed to believe that real estate always just goes up. That's really not the case in most of the U.S. And in fact, most of the homes are still selling for what they were selling 20 years ago. And there's been bubbles, there's been issues, right, where the market went out of control in 2008 and others, but generally it's really a overall flat marketplace. Their jobs don't get better, their lives don't get better, they just live, and their homes are just there. Unless somebody on the call has seen something different, that's my experience with all that Midwest territory.
Yeah, I hear a lot of people call them cash flow markets as opposed to appreciation markets. So
Yep.
The whole idea there is they don't go up in value, but you do get paid every month.
That's right. Yeah, it's a nice market to go for buying investments for cash flow because your cash cost is low on the homes, but the rent is still pretty high. Versus very opposite here in California, where in Seattle and all that, where you can buy a house, but if you're wealthy, you can buy a house, but you can't afford to rent it back out for what you've actually paid for the mortgage. Okay, so we talked about keeping the loan till maturity and then accepting early payoff. The last option for a performing loan is to sell is a technique called selling a partial. This is where if you've got a payment stream coming in, you can legally sell the first N payments, any number you want, for any term you decide that the investor's willing to take. You can sell that front end portion of the payment stream, and then you can keep the back end payment stream for yourself. And I'll walk through that example here in a moment. Any questions so far?
So the payments that are coming in, they're coming into the IRA directly?
In the case if you use an IRA, so generally, back up a moment, the payments come in to the servicer. So we buy the note from the bank, but we don't ever talk to the borrowers ourselves, nor do the banks. The banks and we, in note investors, use servicing companies that actually make all the phone calls to the borrowers and receive the payments. Those payments then, once received by the servicer, get sent over to the bank or to us or to our IRA if that's where we choose to put the money.
Got it. Thank you.
Yep. Okay, so let's talk about this note here. This is 198 payments of $759. We're going to do what's called selling a partial. We're going to sell the first 132 payments. And we'll talk later about why that number 132 was chosen, but bottom line is we're selling the front payments and we are going to keep the back payments. What this does is it sets up a space where the front end investor, this person we're selling to, buys that first 132 payments, and in this example, they're paying us $69,275 for that first 132 payments. That will give them a total of $100,248, which is a 7.3% annualized interest. Any questions on what the buyer, this investor, is buying, what they're purchasing?
Where would they go in order to find your sale of the first 132 payments?
How would somebody find me to buy this asset? Yeah, it's very much a personal relationship. You can't go advertise. If I were to put this asset on the internet or on Craigslist and say, hey, I've got 132 payments to be sold for $69,275, I don't think I'd go to prison, but I would definitely have a lot of fun thinking about going to the Gray Bar Hotel. It's called selling a security. That's a securities exchange violation. So you cannot advertise unless you have a Reg C or Reg D filing, SEC filing. If you have an SEC filing, then you can sell securities. Of course, it comes with a 40-page risk document that explains to the investor all the different ways they're going to lose money. But if they choose to invest with you, they'll make this return. So if the average person...
How do you make a contract for this then, right? I mean, like, there is no any, how to find a lawyer or make all deal work out?
So you're asking the tactical details and how a transaction like this would take place?
Yeah.
Okay, so traditionally, if you find somebody like me who sells mortgage notes, right, partials, then they will have, someone like me would have a contract that a lawyer has written up that provides all the details with regards to how the transaction is going to take place. Of course, I'm not here to sell anything. I'm just letting you know this is what you would do because you asked the question. You would sign the contract. The seller would sign over the mortgage to you, transferring it into your name at the county so that you have collateral against the loan that you made, against the purchase that you made to get the $100,000. The loan would get boarded in your name with a servicing company who would be at your beck and call to make sure you had all the data regarding getting your payments, because they are your payments once you buy it. So it's very much a legal transaction that gives you full ownership of the collateral. If the borrower stops paying, then legally you are allowed to foreclose on the property. In my contracts, I put in a statement that I have the first right to take care of any issues because I am very motivated to make sure you don't blow all my money on bad lawyers. So if I finish out the right side of this foil, just to kind of, then I'll come back and make sure I got your question answered. I'm selling the first, in this case, I'd be selling the first 132 payments. But the back 66 payments are still worth a lot of money. That's about $45,000 over there on the right side of that foil. So if I sell, for example, this 132 payments, and the borrower stops paying, and you decide to foreclose, and you don't know who to hire for lawyers, so you just hire your friend's brother down the street, and he wastes $40,000 in pursuing the lawsuit incorrectly, you might still get all of your payment back, and you'll get all your money back because your lawyer got you your payment, kicked the borrower out of that house and sold it and everything else. But at the backside, any money that you waste in that process comes out of my 66 payments because I don't get paid until you're 100% paid. So in my contracts, the way I write them is that I have the first right to go and take care of any non-payment activities, including and through foreclosure, and I take care of all that costs on my own. That way, I don't leave it on you to take care of all this for two reasons. One is if you're my investor, I want to take care of you. But second, and more importantly, I want to make sure that I get paid on the back end and the money doesn't get lost in poor management of the asset. So that's a typical scenario. Does that make sense?
Yeah.
Okay, cool. All right, so bottom line, 132 payments are sold here. I discussed briefly what I mean by seller backs the front-end investor. Does that make sense to everybody? And legally, I'm not required in the contract to do the foreclosure or to manage the asset for you. And legally, if I were to get hit by a bus, then you'd have to take care of things yourself. But realistically, I and my family are very interested in securing these final 66 payments, and so we do everything we possibly can to ensure that the investor on this front end portion gets paid back. It's just good investor management, but it's also very good for my financials as well. That's what I mean by seller backing the front end investor. The last point I wanted to make on this film, nobody asked it yet. They did last time, but nobody asked it this time. Why am I selling the front end 132 payments for $69,275 when I only paid, if I back up a couple foils, I paid $69,175. So why is that the right answer? And the answer for me is I think there are plenty of investors that would like the comfort of having somebody back their investment for them at a return of 7% versus being out in front like I am, making 11% but taking the entire risk of the sale. And so I choose a number that gets me most of my initial investment out so that I'm not in the deal, except for and until my investors that purchase these partials get paid off. That's how I chose the number of payments and the amount to sell it for. Does that make sense?
Mm-hmm. Richard, what happens if they refinance?
It's a wonderful question. That's actually a wonderful question. That's going to be on the next foil.
Okay.
Before I jump to that one, anything else? Any other questions?
Yeah,
I missed.
Question. So, technically, so when I don't know, maybe this is related to tax or something, right? Because I was wondering, since you got your money back now, but you're not getting your profit right away, maybe after like several years, right? So you're not obliged to pay for that future profit or anything like that upfront, right?
Well, that's an interesting question, and actually that's what I thought. And it depends on how it gets recorded and how the paper gets worked by your CPA. Excuse me. Sorry, I've got a small cold. Just had to put you on mute for a second. Depending on how the paperwork gets filed by your CPA, it's really important if you're going to do this note investing business on my side, that you have a good CPA that knows the note business. On my first transaction I did this way, it got filed incorrectly. And yes, I had to pay tax on the receipt of the $69,000. In that case, it was only $19,000, but I had to pay tax on a portion of it because, and there's a bunch of wonderful tax law that I didn't fully understand in the first pass through. But the bottom line is you are receiving some of your principal back, though not all of it. You're receiving some of your interest back, and the interest is taxable. So again, if you do these investments with cash instead of using your 401k, then you're due for the taxes. You do not have to pay. You don't have to pay the full amount of tax, but there is a portion, the percentage of which you sold, you have to pay. And since in this example I'm selling 132 over 198, I'd have to pay tax on the interest that is returned to me in that time frame. It's a long conversation. I can hook you up with a CPA if you want to walk through it. It's ugly. I hate it, but it's part of the business. All right, there was another question?
Yeah, I missed. Where did you come up with 132? What was the magic?
Yeah, good. The magic was I want to get back all of my investment back, and I want to offer my investor about a 7% return. And so I use
So if it was a different amount, you'd just do a different number of payments.
Exactly.
Got it.
And if my investors, if one of you guys said, hey, I really love this, but I need to make 8%, well, then I can jump that number of payments up to 143 or something like that and get until I get the number to match exactly the percentage I'm trying to dial in. Depends on the investment, on how many payments are remaining and what the risk is to me to make that transaction.
Well, it's really nice. You can get your entire investment back, future stream of payments, and you're flexible for the other party.
That's right. I've got a couple that I've sold where I'm sitting on $50,000 each, and the money's not due back to me for 5 or 10 years. But I'll be happy the day those investors are fully paid off and the mortgage transfers back to me and I get the payments.
Richard, can you talk a little bit more about what you said about how this buyer, the mortgage gets transferred to them, it's in their name. You still have money that you want to get, and yet you've given that up to them. So how does that work?
That's right. So it's not. So it's a great question, but it's really no different than me selling anything else. If I, in this case, I have a contract with my buyer, this investor, where they get the first 132 payments, and at the 133rd payment and beyond, the contract states they have to give it back to me. Now, will they forget? Will they get hit by a bus? I don't know, right? But I have a legal contract that I can enforce that says that after 132 payments, I am to be returned this asset. So I think generally there is some risk that I have to deal with family members if something were to go wrong. There is some risk that I'll never get paid back, right? That I've got, which is part of why I get all my money out up front. That's my strategy anyway. But generally, they have complete ownership of the asset per contract through the first 132 payments. And then after that, once they've been paid off fully, then contractually it comes back to me. Make sense?
Yep, it does. Thanks.
Cool. All right, so let's talk about what happens if there's a payoff. So like I talked about earlier, things do pay off, right? So these two blue mountains here are representing, the light blue is the partial that I sold. You can see that I sold it for $69,275, which is right here. And then over time, this is the amount, the blue area is the amount that's left due on the loan all the way through 132 payments when it finally goes down to nothing left is due. The dark blue mountain is the actual loan, which has got an $83,407 unpaid balance, and it also trends down over time. And you can see that at 198 months, it goes to zero. Those two blue bars, or blue mountains, make sense? This is a typical amortization schedule. And of course, the bank had this loan way back over here when it was flat, which is a really profitable time in the loan, like I explained earlier. Okay, so we sold 132 payments. Now, what if 5 years in, magically, the borrower decides to either sell or refinance? At that point, the dark blue line, the actual loan, has an unpaid balance of $68,111 on it. The light blue loan, the light blue, has an unpaid balance of $42,574. Do you see where those two numbers come from here? Okay, so now that partial investor, if this loan were to pay off, would get a check for $42,574. But during the first 5 years, they also got checks totaling $45,568. So that is a total of $88,142 that they will have received by the end of that 5 years, which magically is 7.3% return. Does that make sense? Should I go back through that again? No? Okay,
Makes
good.
sense. Yep.
All right.
One second, please.
Yep.
Okay.
Yeah, I mean, I've been looking at this now for, I guess, 3.5 years. So for me, it's really, really obvious. And I'm not proposing that it's complex. It's just something most of us don't think about very often, right? At 5 years, the current loan went down from $83,000 down to $68,000, so they paid that much off in principal. And then the light blue went down from $69,000 down to $42,000, so they paid that much off in principal. The delta here, you can guess who that's going to go to. Right, that goes to me after the investor gets paid off. Then I would, at that point, I'd get a check for $25,000 and some change. All right, so let's do another case study. This one's...
In this case, you really have a very good advantage, right? Because you got your... you're supposed to get that money back in 10 years, but now you're getting that difference like right away after 5 years.
Yeah, it's a good thing. It's a good problem to have. Honestly, myself, I'd kind of prefer to be sitting on the beach out here, 198 months and then get a nice big check. But I'm 132 months. But I'm actually totally okay. I'm okay with either getting a check when it happens at payoff. I'm okay with getting a check or if it pays off later. Regardless, at this point, I have no money in, so for me, it's always a good day on this particular loan. And of course, I've got insurance on the asset, or I make sure that the borrower has insurance, make sure that taxes are paid. That's what the servicer does for us to make sure there's no problem so that my investment doesn't get wiped out by something dumb. So there's some details in the background. I'm wiping over a lot of those details, but just giving you the high level.
About what percentage are you giving up to the servicer?
On a loan like this, the servicing is between $11 and $30. Depending on the condition and the number of issues and which servicer we choose to use. I think I'm currently paying $28 or $30 a month on this asset. The payment is $758, so that's someplace around 5%, a little south of 5%. So let's do a second case study. How are we doing on time? Wow, I just can talk all day long about this stuff. Maybe I'll pick up the pace a little bit. This is a non-performing loan. This is a house in Newcastle, Pennsylvania, 3-bedroom, 1-bath, 1,800 square feet. I would never live in this home, unless, of course, I was completely broke. But it is a market value of only $37,000. It's just amazing how inexpensive these homes are. So there's a situation. So this home, when purchased, was purchased for $90,000. They put down about 10%, less than 10%. Their mortgage note was $81,167 at 3.8% interest for 504 months, which gave them a payment of $322.58. All right, so here's my attempt at a bad graphic. The market crashed in 2008. That house was worth $90,000. It's now only worth $37,000. This is an example where the market pricing in that part of the world did move down. A lot of things went bad in that time frame. The home was only worth $37,000. The borrower stopped paying, and the borrower is clearly upside down. Their mortgage note is $75,817, but the home's only worth $37,000. So they're pretty unhappy. All right, so we bought that note for $18,010. That's about half, a little less than half the value of the home, which is a very typical purchase price on a note that's not paying. You think about the risk I'm taking here. I'm spending $18,000 of my hard-earned money hoping that I can either get this borrower to start paying again and get it back to being a performing loan, or that I can find some other way to get them out of the property so that we can turn around and fix it up and sell it and make it available as a good home on the marketplace again. Let's walk through this. So the borrower hasn't been paying since 2008. They had 480 payments due of $322. The borrower conversation between the servicer and the borrower went along something like this. Hey, we paid for 7 years, we got spooked by the market crash, and we stopped making payments. But we love the home, we really don't want to leave. We've been here a long time. Is there anything we can do? Now, the borrower could be lying, the borrower could be telling the truth. I don't really know, but this is the story. So what we offered was a note modification. We offered to bring the unpaid balance down from $75,000 to about 80% of the home value. That offer was made primarily, it's a selfish offer for us. If we can get the home down to about 80% of value, and if the borrower will pay for a year or two, then they can get a loan and they can get refinanced and we can get paid off. And of course, that loan value being at 30 is still a lot more than we paid for the asset. Okay, and then we changed the term down to 360 months at 9%, which gave us a payment of $238 over 30 years. So I brought the payment down significantly for them. I'm not actually sure that's advisable. You want to keep the payment someplace close to what it would cost to rent, just so they feel that they have skin in the game and interest. But this is what we proposed. So that would be 360 payments at $238. This particular borrower was very grateful and started paying a loan. Well, that's not the end of the story, though. So what happened next was a little surprising. They actually, we didn't finish the loan modification. They decided to get a 401k loan, pull out $27,000 and pay off their what's called arrearage. They were behind $27,000 on their mortgage payments, so they gave us a check for $27,000, and then started paying from that point forward. We then sold that note for $24,000, and our total profit in the deal, we paid $18,000 plus about $1,500 in costs, and then received $27,000 and $24,000. Our total profit on that deal was $34,000. That took us 20 months to do. That's a pretty good return. I'm not gonna tell you this is how all the deals go, but this was a pretty good example. This is pretty nice. Okay, so no questions, or are there any questions here?
So why did they do the 27? To get their credit better, or because you already bought the loan, so they don't owe the bank anything, right?
No, I am the bank. So that, to be clear on that, right? They still owe the bank, then I am the bank, and I can sue just as easily as any other bank can. I just hire a lawyer, and I have legal title to the property. I have legal title to the mortgage note. I absolutely can sue. They do owe me the money. Why they chose to reinstate, I couldn't tell you. I was shocked because we had already agreed to do the loan modification. I don't know why they did it.
Okay.
So, like I said, I expected it. I fully expected what I thought would happen, and what typically happens is they sign the loan mod. We usually require, $2,000 or $3,000 or $4,000 in order to do the loan mod, which covers our costs and then gets us a couple dollars in our pocket. And then they pay for 6 months or a year, and then they stop paying again, and then we go through this whole circus again. But that's not what happened in this case. They actually decided to reinstate, and then we sold the note. So overall for us, it was a good deal. Right, we were in at 19.5.
So when you say reinstate, what exactly happens?
So so you can think about your loan today. You make a payment of whatever, let's call it $3,000 a month. If you got 6 months behind, you would owe the bank $18,000 plus fees. If you wanted to reinstate, if you wanted to come clean, catch up, whatever the right terms are you want to use, you'd have to give the bank a check for $18,000 to reinstate your loan.
Oh, okay. So they don't have any clue that you paid just $18,000 for that.
That's right. That's right. Yeah, the sales price of notes is, so notes are actually, so this is interesting. The mortgage is the security deed. I talked about two different documents, right? The mortgage is actually a public record document. It's recorded at the county. That's the security agreement. But the note, the actual mortgage note, is considered personal property, and it's something that you put in a fireproof safe. It's something that you put at a note storage company, but that note is not seen by anybody, and nobody knows how much money you pay for a note. It's considered personal property. So nobody can look up on the county records how much I paid for that note. They can see that I own the note, but they can't see what it's for. Okay, so that's a non-performing note. We have just a few minutes left. This next one's pretty quick. So here's another $38,000 non-performing note. A $38,000 home with a non-performing note on it. This is Beach Street, Ohio, single-family residence, 4-bedroom, 1 bath. It wasn't a bad little place. So we paid $6,000 for this note. We got it on a screaming deal. We spent a small amount of money on the property and paid the back taxes because they were close to redemption. We had total closing costs of $2,000, and bottom line, we were in this deal $11,500. We took possession of the property, and I'll walk through in a moment how that happened. We took possession of the property and resold the property for $38,000, which gave us a profit of $26,500. That's a pretty good return. Basically what happened, we approached the current borrower and asked them if they wanted to try to reinstate. And like many in this part of the U.S., they were living paycheck to paycheck, could not afford to do that, and they were just wanting to get out from underneath the debt that they had. So we did what's called a deed in lieu. This is a legal document that says, hey, you can sign the house over to us, and we'll take it away from you. We'd be happy to take it off your hands. So they did that. We wiped the note clean, so they no longer owed us any money, and they were able to walk away from the house. We then turned around and sold that house really quickly with just minor cosmetic changes, no significant investment.
And why do you think the note price was so low for this house?
So why is the house only worth $38,000, or why was I able to buy the note for $6,000?
That's right. Why were you able to buy it for $6,000?
Yeah. So I spent about $110,000 in April of 2018 on 18 assets. So I bought what they call a grab bag, which is a bag full of garbage, and in that bag full of garbage was this home here. And so the average sales price on the assets that I purchased, I quantified this one at about $6,000.
And how do you hear about this, like this whole grab bag or this specific
Sure.
deal?
Sure. So I found out about note investing through a couple of different websites and real estate investing websites. And then when I decided I wanted to get into real estate 3.5 years ago, I went to a local real estate association in Sacramento, run by a guy named Tappan. It's a California Capital City Wealth Builders over in Sacramento. Anyway, they meet on, I think, the second Wednesday of every month. And so I was hanging out there for 3 or 4 weeks on Wednesday nights, and this person came in that was talking about note investing, just almost like I'm doing here. And by the end of that first hour, he had me sold for $1,200 to go to his Saturday session where I was going to learn all about note investing. And so then I went to that Saturday session for $1,200, and they offered me 3-day weekends, 2 3-day weekends for $40,000. And you can imagine what I did. And from there, I got into note investing, and I know a lot of the players. The bottom line, to answer your question, if you wanted to get into note investing, I don't encourage you to just go out and buy a note on your own. I think that would be uneducated. And very likely to lose money. You need to find somebody, either go through the training like I did, or find somebody who has, or partner with somebody who has training to get involved and take care of yourself. Any kind of investing, whether it be investing in rentals or fix and flip or apartment complexes or right. You can't just do it without training wheels. You got to have somebody help you out. So you can go. There are retail websites you can go to. I can give you the names of them, and you can go out there and you can look at the properties, and you can pull your credit card out and you can buy a note. I would be very, very careful about doing something like that. If you want to know who to talk to or where to get training, I'd be happy to help you get started.
Got it. Thank you.
Yeah.
Oftentimes, not only training is good, but also having a mentor who will be there that you can ask questions of. Is,
absolutely.
What a lot of real estate investors do.
That's right. And the training that I paid for, they are a full mentorship program. I paid a one-time fee, and they've been helping me for 3.5 years. They review all of my deals. I meet with them 3 or 4 times a year. They have big events. I paid a lot of money, but I get a lot of support. And I went on the internet and I went to biggerpockets.com, and I thought, I can do note investing. I'm just going to go do it. And I thought, oh, hold on, Richard. Took you 20 years to build the pile of wealth you have today. You probably shouldn't just go give it away. So I spent a little bit of money on training. All right, so let's talk quickly about the exit strategies on notes. So on non-performing notes, so one exit strategy set is all the same ones that could happen if you can get the loan performing. If you can modify the loan, you can do all the same things, because now it's a performing loan. If you can get the borrower to pay, it's now a performing loan, and you can keep it to maturity. You can accept an early payoff. You can sell a partial, or you can just sell it as a performing loan. Those are all valid exit strategies. You can do a deed in lieu, like I talked about a minute ago. You can have a legal contract written up that somebody will just give you the property for wiping the loan out. And then finally, you can foreclose. And this is the ugliest part of the business, and it's one that I've had to do a few times, and I don't really enjoy it. It's not something I want. I much prefer the top of the stack here. But once foreclosed, you can sell it at county auction. You can own it as a rental, or you can clean it up and put in a renter and a property manager and then sell it as a turnkey property. Those are the different exit strategies out there for you on non-performing loans.
So what did you usually choose?
My pie in the sky, absolutely wonderful thing is to buy a non-performing loan at half the value of the loan, talk the borrower into starting to pay again, at some where I give them a ton of money off their balance and get them happy, but then now they're paying. Maybe and then sell that as a partial. That would be, if I could do that once a day, I'd be a very wealthy man.
Sorry, I didn't ask right. So you said you had to foreclose a couple of times. Which thing did you end up choosing? Did you just dump it as easy as you could?
I've got one that sold at county auction. I've got 2 that I currently own as rentals. I've got 2 that I lost because once I got into the house, they were so incredibly destroyed on the inside that there was no way I was ever going to actually profit off of the deals. So my case studies that I showed you were all case studies where I made money. I can promise you that is not the only path that I've chosen in this business. I've paid for education beyond my formal training by buying assets that were maybe I could have perceived the problem before I bought them, but I don't think I could have. Anyway, I have one that sold at county auction and did quite well on that one, 2 that I own as rentals, and then 2 that I actually sold as is to local investors, trying to minimize the amount of money I lost on the deals.
So what percentage of your properties have gone to foreclosure?
1, 2, 3, 4, 5 out of 36. So 15%?
Mm-hmm.
Something like that.
What do you think your average return is from your note investing annual?
So I have, I'll just throw a number out there, at some place around 15%, but I have 3 LLCs with other investors and I have 3 IRAs. But an average number is someplace around 15%.
Okay.
Another question?
Yeah, you mentioned that for the first or second case, you probably would talk to the current person, whoever is living there, or current owner, right? So is that like you who would be talking, or is that your service company that will be talking with them?
Yeah. So on almost all of these scenarios, I'm working with vendors. I don't personally have. I have a full-time day job, right? So do you. I can't afford time to be talking to borrowers every day, all day long. So I never give out my phone number. I talk with lawyers. I talk with people that are going to mow the lawn. I talk with contractors. I talk with servicers. But I do not ever talk with the borrowers. I don't want to talk with anybody whose life's in the balance and then they're panicked about it. I don't want that headache. You're legally able to call the borrower if you want to, but I don't do that.
And the emotion that goes along with that.
That's right. That's right.
Emotionally charged conversations. Yeah.
Yeah. And once you get involved in that conversation, you're never getting out, right? They're going to know you. They're going to want to talk to you and complain when their water heater goes out, even though they own the house. Once they have your phone number, they're going to call you for all manner of problems. I don't want that. So I take some risk that the servicer doesn't do a great job. But then I watch the comments in the web portals and make sure that I'm in line with what they're recommending. And I think I probably could do a better job than they do, but they're making minimum wage, and I'm not having to do it. I'm not having to do the work, so I can't complain too much. Just super quick, but
2 minutes left.
Yeah. So servicers collect all the payments, they do all the taxes and insurance, they make sure that we're licensed and compliant, and they manage the borrower workout. It truly is a passive, from this perspective, it is truly a passive investment. The borrower sends the payments to the servicer, and the servicer sends the payments to us. That's the way it's supposed to work. Okay. So
one question. So how much the percentage the servicer tax charge?
It depends on the status of the loan. If it's a performing loan, you'll pay between $11 and $30 on the payment. If it's a non-performing loan, the typical is around $90 a month. And so then it depends on how big of a note you buy. If you buy a note for $20,000 with a payment of $200 and you're paying $30 every month for servicing, then you're paying a 15% fee. If you buy a loan for $150,000 with a $2,000 a month payment, then your $30 is a pretty small percentage overall.
So one last question, I guess. If people wanted to get more involved with this, do you want them to contact you over email, or how can people follow up with you?
That's a good question. Yeah, you guys can email me. I don't have any problem with that. I'm not really taking on investors at this point, but I would totally not mind helping you guys get started and pointing you in the right direction. I'm always open to conversations, and I really do enjoy the business. So, mentoring you get through it, I think I wouldn't be opposed to. But I'm not taking on any investors right now. I've got way too much to do at work, and it's too busy.
All right. Thank you so much for taking the time to come and share with us, Richard.
Yeah, thank you.
This was awesome. Thank you
so much.
Thanks a lot. Really upset.
Awesome. Yeah, send me an email if you guys want to talk. I'd be happy to get together and do more on this.
Okay. Thank you so much.
Thanks a lot.
Bye.
We'll see everyone next week.
All right. Bye.
Thanks, guys.